Welcome to the deep dive. Today, you've tasked us with navigating a really interesting, if intricate, area IFRS 7, financial instruments, disclosures. You sent over quite a stack of information on this accounting standard, and our goal is to pull out the truly crucial insights for you.
Absolutely. And we've got, quite the range here, everything from official papers by EFRAG, that's the European Financial Reporting Advisory Group and the IASB staff, right through to academic research looking at the impact of IFRS 7, plus implementation guidance and what users actually think.
So think of this as your shortcut. We're aiming to clarify what IFRS 7 is, exactly what disclosures it requires, why they actually matter, and we'll even touch on some ongoing debates and what the research is saying about its effectiveness. Okay, let's dive right in. What is IFRS 7 in simple terms?
Well, in essence, IFRS 7's main objective is to make sure companies give enough information so that people looking at their financial statements, investors, analysts, people like yourself can really understand the significance of financial instruments to the company's financial position and its performance.
Okay.
And crucially, it also wants to highlight the nature and extent of risks that come with those instruments. The standard itself really hammers this home in its basis for conclusions.
Right. So it's about visibility, making sure the tools the company uses and the risks involved are clear. What exactly falls under this financial instrument category? What's in scope?
It was pretty broad, actually.
hmm
It covers basically all financial instruments recognized on the balance sheet, your typical assets and liabilities. But it also includes some instruments that aren't on the balance sheet but still fall under the scope of IS 39, another standard. Interestingly, some guidance notes this can even include certain contracts to buy or sell non-financial things like commodities if they meet specific criteria in IS 39.
Wow. Okay. So it's a wide net, almost any financial agreement, it sounds like. Are there specific things it doesn't cover, any carve-outs?
Yes, definitely. There are some important exceptions. Things like a company's investments in its subsidiaries, associates, or joint ventures, those are usually accounted for under different standards. Also, employer obligations for employee benefits under IS 19. Most insurance contracts, though, watch out for embedded derivatives there, and certain share-based payments under IFRS 2. Several of the documents highlight these exclusions.
Got it. Broad, but with clear lines. Now, you mentioned IFRS 7 builds on older standards like IS 30 and IS 32.
Exactly. It essentially took the disclosure requirements that used to be scattered, partly in IS 30, which was bank-focused, and partly in IS 32, which dealt with presentation, and it consolidated and significantly beefed them up. In many areas, IFRS 7 demands much more detail. It was a clear move towards more comprehensive disclosure, as the background documents explain.
Okay, that sets the stage nicely. Let's get into the specifics now. What are the main disclosure areas IFRS 7 really focuses on?
Right. There are several key buckets you should be aware of. Let's start with the balance sheet disclosures. Companies need to show the carrying amount, basically the book value, and the fair value, or market value, for each category of their financial assets and liabilities.
Categories like?
Things like instruments held at fair value through profit or loss, held to maturity investments, loans and receivables, available for sale assets, and liabilities measured at amortized cost. The guidance documents lay these out pretty clearly.
Makes sense. Book value versus market value. What if a company moves an instrument between these categories, like reclassifies it?
Good point. If they do reclassify something, say from available for sale to held to maturity, they absolutely have to disclose the reasons why they made that change. Transparency is key there.
And I think I saw something specific about loans and receivables that are measured at fair value through profit or loss. Seems like extra scrutiny there.
Yes, exactly. For those specific instruments, there are additional disclosure requirements. Companies need to reveal their maximum credit risk exposure related to those assets, the impact of any credit derivatives they might use to mitigate that risk, and importantly, how much the fair value changed specifically because of credit risk changes, both in the current period and cumulatively. It gives a much deeper dive into the credit aspect for those particular assets.
Okay, really drilling down on credit risk for those. What about the income statement and equity? What needs disclosing there?
For the income statement and equity, IFRS 7 requires disclosure of the various items of income, expense, gains, and losses related to financial instruments. This includes total interest income and expense, calculated using the effective interest method for things not at fair value through P&L, and also fee income and expense. Helps you see the ongoing P&L impact.
And if a company gets rid of a financial asset?
Yeah.
sells it or something.
Yes, derecognition. When an asset comes off the balance sheet, companies need to disclose information about that, including any gains or losses recognized on removal.
Okay. And within equity, I remember reading about movements within equity.
Right. If there are transfers of cumulative gains or losses between different components of equity, like moving something out of the available for sale reserve that needs to be disclosed,
Mhm.
along with the reasons why, several sources mention this, ensuring clarity on those internal equity shifts.
Got it. Helps track where the value is going. Now, fair value, clearly a huge part of financial instruments. What disclosures are needed about how companies figure out those fair values?
Oh, this is critical. When fair value is used, companies must disclose the methods and the key assumptions they use to arrive at that number. This isn't just the final figure, it's about the inputs. Things like assumptions about prepayment rates on loans, expected credit losses, interest rates, discount rates used. An exposure draft we looked at really emphasizes this. You need to see the workings.
So show your math, essentially. And there are different levels of fair value, right?
It's exactly the fair value hierarchy. It's crucial for understanding how reliable or subjective a fair value measurement is. Level 1 is the best quoted prices in active markets, like a common stock. Level 2 uses observable inputs, but not direct quotes for the exact item, maybe based on similar assets. Level 3, Level 3 uses significant unobservable inputs. That means more reliance on the company's own models and assumptions.
Level 3 sounds like the one to watch closely then, given the judgment involved.
Absolutely. And for those Level 3 fair values, IFRS 7 requires even more. If changing one or more of those unobservable assumptions to a reasonably possible alternative could significantly change the fair value, the company has to state that fact and disclose the effect of those potential changes, sort of a sensitivity analysis for the valuation itself. It gives you a sense of the potential volatility or uncertainty in that Level 3 number.
Okay, that's a lot on the numbers balance sheet, income, equity, fair value. Let's shift to risk. Arguably the core of IFRS 7, wouldn't you say? What are the main risk disclosure requirements?
Definitely central. The standard requires extensive disclosures about the risks arising from financial instruments. The big three are credit risk, counterparties defaulting, liquidity risk, not having cash to meet obligations, and market risk, losses from price changes like interest rates or FX. For each type, companies need to provide both qualitative and quantitative information.
Qualitative being, how they manage it, policies, procedures.
Precisely. Descriptions of how the risks arise, the company's objectives for managing risk, their policies, the processes they use, and then quantitative is the summary data numbers showing their exposure to each risk at the reporting date. Importantly, IFRS 7 says this information should align with what's provided internally to key management, what they tell the board, essentially.
That makes sense. External reporting should mirror internal risk management views. Let's break down the risks. Credit risk first. What specifics are required?
Okay, credit risk. Disclosures need to cover the exposure to loss if counterparties fail to pay. This means details on assets that are past due or impaired, information about any collateral held or other credit enhancements obtained, and disclosure of significant concentrations of credit risk, like too much exposure to one industry or region.
And what if the balance sheet amount doesn't show the full potential loss?
Good point. If the carrying amount doesn't represent the maximum credit exposure, maybe due to netting arrangements or guarantees, the company has to disclose that maximum exposure separately. The guidance is clear on making the full potential risk visible.
What about the quality of assets that aren't past due? The performing ones?
Yes, disclosure is required about the credit quality of financial assets that are neither past due nor impaired. Plus, information about assets that have been renegotiated because the borrower was struggling. It gives a fuller picture beyond just the problem assets.
Okay, moving to liquidity risk, the risk of running out of cash. What's key here?
The main requirement is a maturity analysis for financial liabilities, both derivatives and non-derivatives. This shows when obligations are contractually due. Companies might show this based on contractual dates, or, if they manage liquidity differently, based on expected cash flows. It gives you a timeline of upcoming cash outflows.
So a schedule of when debts need paying. Anything else?
Yes, they also need to provide a narrative description explaining how they manage the liquidity risk shown in that maturity analysis. And potentially, they might also disclose a maturity analysis of financial assets they hold specifically to manage liquidity risk. like readily saleable securities. It connects the numbers with the management strategy.
Right, context for the numbers. Finally, market risk losses from price movements. What's the requirement?
Sensitivity analysis. For each major type of market risk, they're exposed to currency risk, interest rate risk, other price risk like commodities or equities. They need to show how reasonably possible changes in those market variables would affect profit or loss in equity.
So showing the what-if scenarios. What if rates go up 1%? What if the euro weakens?
Exactly. And they need to disclose the methods and key assumptions used in preparing these sensitivity analyses and any changes from the prior period. Transparency about how they did the analysis is important.
Is there any alternative to this sensitivity analysis?
Yes, if a company uses a more sophisticated approach, like value at risk, VAR, internally, which often captures interdependencies between risks, they can disclose that instead, provided they explain the model and how it's used. Some flexibility for more advanced risk managers.
Got it. And I think there was something about transfers of financial assets, too, special disclosures.
Yes, if assets are transferred but not fully derecognized, or if the company retains some continuing involvement in assets that have been derecognized, specific disclosures are needed to explain that involvement and the associated risks. It ensures you understand any lingering exposure even after a transfer seems to have happened.
Okay, that's a really thorough look at the core disclosure areas. It's obvious IFRS 7 demands a lot of transparency. Let's switch gears now to ongoing discussions and research. EFRAG has been looking at the scope and maybe adding more disclosures.
That's right. There's been discussion based on tentative IASB decisions about potentially extending IFRS 7 scope to include disclosures about a company's own issued equity. The idea is to give users like you better info on the company's financing and ownership structure. An EFRAG paper and an IASB staff paper both delve into this.
Disclosures about their own shares and equity, what specifically were they thinking about?
One proposal was requiring disclosure of significant judgments made when classifying instruments or parts of them as either liabilities or equity. That equity classification can be tricky,
Definitely.
So more transparency on the judgment calls there. Also disclosing terms and conditions that might kick in or expire over time, affecting the instrument's nature, trying to capture the dynamic aspects.
Interesting. Trying to clear up that gray area. Any other potential expansions discussed?
Well, the IASB staff looked at things like economic compulsion, where an equity instrument has features that strongly push the company to redeem it, making it act a bit like debt and indirect obligations. But for now, they decided not to propose specific new disclosures in those particular areas, according to the EFRAG paper.
Okay, so some movement on equity disclosures, but other ideas parked for now. What about the academic side? I saw a study on the cost of equity capital, linking it to IFRS 7 compliance.
Yes, that study in the Gulf region was interesting. It found a negative link, basically. Banks that complied more thoroughly with IFRS 7 tended to have a lower cost of equity capital.
Lower cost, how does that work?
The theory is that better, more comprehensive disclosure reduces information asymmetry, that gap between what the company knows and what investors know. Less asymmetry means investors perceive less risk, so they demand a lower return, hence a lower cost of capital for the bank. It suggests a tangible financial benefit to good disclosure.
Fascinating. So transparency can actually pay off directly. Did the study say why financial instrument risks are so important to investors?
It highlighted that investors definitely see these risks, credit, market, liquidity, as major factors in their decisions. IFRS 7 gives them the tools to assess these risks. The authors also noted there wasn't much prior research directly linking IFRS 7 compliance to cost of capital, making their findings quite relevant.
Provide some hard evidence then. Now, what about the users themselves? The investors and analysts actually reading these disclosures, what do they think? I saw a CFA Institute report.
Right, the CFA Institute surveyed users. The takeaway was a bit mixed. Users definitely find the risk disclosures, credit, liquidity, market important, even essential, but they often struggle with understandability, consistency between companies, and comparability. The information's there, but it's not always easy to use effectively.
So the quantity is there, but maybe not always the quality or clarity. What specific gripes did they have?
They wanted more granularity in credit risk breakdowns, better info on counterparty risk, collateral information integrated more clearly. For market risk, they felt the sensitivity analyses could be more meaningful, more insightful. Basically, a call for disclosures that are easier to digest and compare apples to apples across companies.
Sounds like a common theme, the data's there, but making sense of it across different companies is the challenge. Did other research pick up on this, like that Lancaster University study?
Yes, exactly. The Lancaster research looks specifically at credit risk disclosures after IFRS 7 came in, and it confirmed that diversity. They found significant variation in how granular companies were, how much they disaggregated the information. This lack of uniformity makes comparison really difficult for users.
Echoes the CFA findings perfectly. Did the Lancaster study see differences between, say, banks and regular companies?
It did. For banks, there was lots of variation in the entity-specific details in their expected credit loss, ECL accounting policies, and how they used macroeconomic scenarios. For non-financial corporates, the focus tended to be more on overall credit exposure, the ECL estimation approach, and general asset quality. So different industries focus on different aspects, adding another layer of complexity for comparison.
Right, different industries, different focuses makes comparability harder. And finally, there was just a quick mention of collateral in one document.
Yeah, just a reminder that while collateral provides security for a loan and usually lowers the interest rate, it doesn't automatically mean the loan has low credit risk. You still have to look at the borrower's ability to repay. Collateral is Plan B, essentially.
Good point. Plan B, not a guarantee. Okay, let's try to wrap this up. What are the main takeaways from this deep dive into IFRS 7?
Well, I'd say the big picture is that IFRS 7 is fundamentally about driving transparency around financial instruments and their risks. It mandates a huge range of disclosures, balance sheet, P&L, fair value, and especially the big three risks: credit, liquidity, market. This information is really vital for investors and others trying to make informed decisions.
But it's also clearly a complex standard, and it's not static, is it? It's still evolving.
Absolutely. The ongoing discussions, the research we talked about, it all shows IFRS 7 is a work in progress. People are constantly evaluating its effectiveness, trying to improve it. We see pushes for more specific disclosures like around equity and that consistent user demand for better understandability and, crucially, comparability. It's definitely a living standard.
A living standard, constantly adapting. Okay, that brings us to our final thought for you, our listener. Based on all this, think about how the level of detail, the quality of these financial instrument disclosures might actually influence your assessment of a company. When you're looking at those notes, what specific piece of information, maybe about level 3 values or liquidity maturities or credit risk concentrations, would give you that aha moment, that sudden clarity about the company's financial reality? Something to ponder about the real world impact of these rules. Thanks for joining us for this deep dive.